Everybody, thank you for joining us today for our ACA Phoenix Business Journal Small Business Boot Camp Workshop. Today, this is the second in the workshop series that we're doing in conjunction with the Small Business Boot Camp, and we're excited to have you with us today. I'm Robert Theobald, Small Business Ombudsman and Vice President of Small Business Services at the Arizona Commerce Authority. And what we're going to do right now is I'm going to stop sharing my screen here, and I'm going to turn some time over to Ray Shea with the Phoenix Business Journal before I jump back into my kickoff piece as well.
Thanks, Robert, and good morning, everyone, too. We're delighted to have you all here. We have a great turnout here this morning. Special thanks to the Arizona Commerce Authority. It's a great partnership that we've put together over the past 3 or 4 months working on this. And of course, our participants here this morning representing Wells Fargo, REDW, Gallagher and Kennedy, and of course we have Nancy Sanders from the SBDC here to share some insight too. So delighted to have you all here. You know, as the Phoenix Business Journal, we're really interested in hearing some of your great stories, some of the success stories, some of those of you that are starting small businesses, some of the background behind what you're doing. So as you go through today's workshop, you know, jot some notes, make some questions and share them either through the chat feature or to follow up to. We want to know what you're doing out there too. Small business is very important to us as it is to the state of Arizona, certainly too. Small business is a key component and a key driver of economic success here in Arizona. So take some great notes, share with the participants here too, some of your questions, and follow up with them as necessary too, because there's a lot of great content to be shared here this morning. And on behalf of the Phoenix Business Journal, thanks so much for being here. Robert?
All right, thank you, Ray. So I'm going to jump back in, share my screen real quick, go through a couple, housekeeping items. So throughout this workshop, if you have questions, we ask that you place them in the Q&A box at the bottom of the screen, and we'll try to answer them throughout, or at the very end, we have some time set aside for Q&A as well with our participants. So very important there. And then if there's something that you need to get in touch with, you can we're going to use the chat for some interaction. We're going to have some polls to participate in. It's going to be, I think, a very fun workshop for doing it on Zoom. I know we'd all much rather be in person in a lot of ways for a workshop, but we are excited to have everybody here and try some new technology here on our Zoom for this workshop. First, again, as Ray mentioned, I want to thank all of our workshop partners, the Phoenix Business Journal, Wells Fargo, Gallagher Kennedy, REDW, and the SBDC state network. They're all great partners with this, and we're excited to have them with us. Some things that some of you may not be familiar with is the Small Business Boot Camp. Many of you joined because of the boot camp, but there may be some that haven't heard of the Small Business Boot Camp. And this is a webinar series that the Arizona Commerce Authority started in April of 2020, and we've been continuing it throughout the pandemic and transitioning it a bit to help businesses post-pandemic, or as we get to the endemic phase. And it's designed to help small businesses prepare, plan, and grow. It is a statewide initiative supported by all of our community partners. It is a content library, and let me explain a little bit about that. I believe I have another slide for that, but the content library is we record all of the webinars, and so we have over 200 webinars that we have hosted in the boot camp, and those webinars are shared on the content library webpage. You can sort by those different categories you see on the screen to find the webinar that's going to best fit your needs. All experts, you have to listen to me for a little bit at the beginning of each one, but we bring in experts to share their expertise and their experience, and they're pretty awesome. And then what we started this year is the workshop series with our community partners, such as today. And we have about one a month that we'll be doing, sometimes more, but we're really excited about that. So this is the, excuse me, sorry about that. So real quick, some other programs that the ACA has that people may need to know about is the Small Business Services Program. We have the Workforce and the Arizona MEP. These are programs that small businesses and businesses throughout Arizona can leverage to help support your growth and for your business. Another program that's very simple but very helpful is if your business is looking to grow into a new area, new category, new city, or you're just looking to start, our small business checklist can help you identify the commonly requested licensing, registration, and compliance needs at the local, state, and federal level. So keep an eye on that. And with that, we're going to jump into today's session. So I'm going to stop sharing here. We've got a great lineup. Today, we're going to start with Wells Fargo, with Tim Maxey from Wells Fargo. He's going to dive into some pieces that small businesses need to know about as they're talking about, you talk about banking and bankers. After Tim, we're going to jump over to Steve Boatwright with Gallagher and Kennedy. And I'll let each of these presenters do a little introduction of themselves when they pull up their time. From the legal side of things, we'll jump over to Chris Henderson with REDW, an accounting firm, and learn some things that you and your accountant can do together to help maximize your potential for getting funding as you look to grow. And then we're going to wrap up with Nancy Sanders from the SBDC and talk about some of the programs that they have to help small businesses that are looking to grow and expand the service they can provide. They're a great resource throughout the state. And then we'll wrap up with a short Q&A and be close out at about 11 o'clock this morning. So again, we thank everybody for being here. And Tim, we'll go ahead and turn the time over to you.
All right, thank you, Robert. Let me share my screen here. All right. All right, well, welcome everybody. Thank you, Robert, for having me today. Really appreciate that. So as he said, I am Tim Maxey with Wells Fargo. I'm the lead business growth strategy consultant here in Arizona, where I live with my wife, who's also a small business owner. She has been for the last several years here in Arizona, and our 4 kids. So small business, definitely my passion. I love coaching around small business consulting, and something I've been doing for quite a while with Wells Fargo. So again, thank you for having me for this extremely important topic when it comes to the success of your small business, and as we talk about capital. So today, what I'm going to look at is the steps that you can take to build a stronger credit profile as a business owner. We're going to discuss ways that may help you when applying for financing. We're going to look at different financing options and things that you want to consider when thinking about capital for your small business. I'm also going to sprinkle in some tips too, as you work with your banker, to really make the process as easy as possible and set you up for success when you're looking for capital. So what I'd love to do is start with our first poll, if we could get that one loaded up. All right, I saw it pop up on the screen here. So the question is, how comfortable are you with your business's current capital? So are you feeling very comfortable, fairly uncomfortable, or that very uncomfortable, I don't feel good at all about it? So if you want to go ahead and put in your response here. And give it another second. All right, so we got some results here. So a couple of you are feeling pretty comfortable right now. Some very or fairly. I would say the majority, it looks like over half, are feeling either uncomfortable or very uncomfortable. So, and I would say that's what we're seeing overall too, that there's that comfort level of, I wish I had access to more. I wish I had more capital, and I could do so much more if I had more capital. So let's talk through a little bit of that today. All right, so here's the agenda that I have for my slides. We're going to talk through managing credit. We're going to look at what potential lenders may look for. The business credit life cycle. I think it's important to understand where your business is at in terms of the life cycle, and financing and capital can look different in each of those areas. Then we're going to make sense of some financing options. And at the end, I'm going to provide you with some free educational resources as well to help your business. All right, so let's dive into managing credit. All right, so it's important to look at credit as a business asset like any other. You don't want to guess about where you're at around small business credit. You do want to actively manage it. So when you look at it as an asset, it'll help you to start thinking about it that way as well. So you can rely on credit to provide working capital, support plans for growth, capitalize on unexpected opportunities when they come up. And sometimes it makes sense to use cash that you have on hand, but there's times when you really need access to some financing as well. So a clear understanding of your needs, thorough preparation, some helpful information can help you choose the appropriate financing options that may help keep your business running smoothly and help it to grow. So we're going to talk a little bit about how your banker can be a valuable resource in this process. I'm going to present a little bit about credit and creating a sound financial footing, banking strategically, and how your banker can come alongside that. But before we get into that, I do want to bring up one more poll about your relationship with your banker. If we could load that one up. So how often do you go to the bank and meet with your banker now? So do you even know your banker? And if you do, is it once a year, a couple times a year, maybe 4 or more? So throw your answers in there. And then from that, I'll share some insights of what the bank recommends and how we can support you. So again, how often are you going to the bank, meeting with your banker? Never, don't know my banker. Yeah, that's the majority. We do see that. There's a lot of, if we're asking small business owners, they're typically saying, I don't even know who my banker is. So that was something I would love to impart with you today is know your banker, make that a relationship. Some of you do once a year, 2 to 3 times a year, 4 or more, a couple cases. Yeah, super important to build that relationship and really understand how that banker can help you and understand your business so we can help with capital as well. All right, thank you. All right, so what exactly is your credit profile? It's not just a number on a report. It also includes information about business practices, banking relationships, past and current financial activity, and even the way you present your financial history and future. So in short, it's everything a lender sees in you and your business. So let's go through some steps you can take to build your credit profile. So first, start by creating a sound financial footing. Even if you have no immediate plans to apply for a loan, start taking steps today to build your credit worthiness in the name of your business. And it's important to look at financing early. So when you do go in to meet with a banker, maybe you're setting up your accounts for the first time, you're excited to get the accounts going, you've got your business set up, you've done all the legal stuff. You need to talk about capital early on too. Your banker is probably going to mention it. They're probably going to talk to you about a business credit card. They'll probably talk to you about a business line of credit, maybe a loan. And a lot of times what we're seeing is businesses saying, no, not yet. Let me get business running. I want to get off on the right foot, and then I'll come back and talk credit. But at that point, it's probably or potentially too late. So even if you could get access to a business credit card or a small line of credit, I mean, it could be $5,000 to $10,000 line of credit. That is super important to get your credit for your business started off on the right foot. You may be thinking down the line, oh, I want 100,000, I want $1 million. But you need to start somewhere. So the importance of when you first meet with the banker, you're setting up your accounts, ask them about credit, ask them about options, and how credit can support your small business's growth and success. So I'll talk more about that as we go on and how you can use credit to really kick off your business and help grow your business. The other thing is you want to separate personal and business expenses by establishing dedicated business checking and savings accounts. We do see a lot of small business owners use their personal accounts. definitely creates some challenges when we're reviewing to approve you for credit. We do need to see cash flow. We need to see money coming in and out. The other thing is, if you have accounts at 6 different banks, that can be a struggle when we're trying to prove cash flow. And we're trying to see, all right, money goes to this bank, money goes over here, money goes over here. How do we put that story together? So the more you can consolidate, the better. You also want to get a free copy of your personal credit report every year. Clear up any issues. Personal credit is extremely important when we talk about business credit as well, and your lendability. Know for sure what's on there. It's beyond just the score. So you may say, oh, my credit score is up 720. It feels good. But when you look at the credit report, there could be some issues out there that could hold you back from getting what you need for your business. There could be maybe you're overextended on some lines. Maybe you have too much out there. Maybe you don't have enough. Maybe credit is new. So really know what's on there, and that'll help as you have that conversation with your banker. Bank strategically. Solid banking history can help with credit worthiness. Again, a lot of banks are relationship lenders. We want to have that relationship with you. We want to see, how are you managing your accounts with us? What's the cash flow look like in your accounts? Manage your banking relationships by keeping your accounts in good standing. Try not to keep those from going overdrawn, avoid bad checks. It happens to everybody, but try to minimize that as much as possible. And like I said, you do want to demonstrate a consistent cash flow of funds throughout time in the account too. So the longer you have those accounts and you can show money going in, that helps too. And now, as the poll suggested too, you also want to cultivate the human side of the banking relationship. Pay attention to the face-to-face aspect of the relationship. We actually recommend 3 times a year to meet with your banker. So every 4 months, have that meeting, check in with them, let them know how business is going, update any information. If your revenue is increasing, let us know. If you're struggling, let us know. There's ways we can help depending on different situations. And the more we know, the more we're able to help you out and get you access to the capital that you need. As you meet with the banker regularly, we're going to get to know you, your industry, your goals. Share with us what you want in the next 5 to 10 years. And we will really work with you on how we can get you ready for those next steps too. The other part of this is, as you're working with your banker, and maybe you do it up front and you apply for a line of credit, or maybe it's later on and you're looking for some more financing, some larger amounts of capital. Be very organized in your approach. Make sure that you're getting information back quickly to the banker as they're requesting it. Make sure that the documents that you're bringing in are well organized, well laid out. We've had them sometimes where they're just writing financials handwritten on a piece of notebook paper that they ripped out. I've actually seen that several times. And it's information, but it's so much quicker for us when we can see it laid out in a nice, concise manner. It's organized, you get it back quickly. That really will help you, because a lot of times when you're needing credit, you needed it yesterday, right? So the quicker you can get it to us, the quicker we can have turnaround time. We can look at it easier, analyze what we need to, and then get you access to the capital that you need. So potential lenders, we may review personal and business credit when making a credit decision. So on your credit report, it aggregates information collected by banks and companies that you do business with, and provides information directly to credit reporting agencies. So your personal credit report is going to include payment histories from credit financing. We could look at bankruptcies, tax liens, inquiries from recent applications. On your business credit report, we're looking at much of the same thing: credit activity for the business, history of payments from vendors and suppliers. So it's important to make sure you're keeping those relationships solid. That does get reported. The credit reporting agencies that we use is Fair Isaacs, which is FICO. You've heard FICO score. And then for business is Paydex from Dun & Bradstreet. So in case you're curious what banks are looking at. The 5 C's of credit. This is actually one of my favorite things. And I know it sounds super basic, but if you were to ask anybody, tell me the 5 C's of credit, you might get 2, maybe 3. They don't always know all 5. And this is actually where I teach managers, bankers, and leaders in the bank of where do we start with credit. So what are just the basics? What do we have to know? And this is important for you as a small business owner to understand the 5 C's of credit as it relates to your business. So let me run through these real quick for you. So credit history is first one. That shows how you've handled credit obligations in the past. It's an indicator as to what a lender may expect in the future. So as a business owner, your personal and business credit histories are both relevant, as is information about your outstanding debts. So I will tell you for Wells Fargo, I don't know if it's the same for every bank. I know it is for most, but we do require a guarantor on every business credit that we do, which means we're going to look at one of the business owners' credit profile when applying for credit, if not more. So we may look at others as well. Collateral is the next one. We often call this security. It can offer a backup source of repayment for secured financing. For example, investments, you could use real estate, equipment. I remember a while back, I helped a restaurant and we did financing with their walk-in freezer. So we were able to use that as equipment. So be thinking about what kind of collateral do I have out there? What kind of large pieces of equipment or investments do I have that I could potentially use in case I need access to capital? Which brings us to capital, which is what we're talking about. But this is the business asset that can be easily turned into cash. Typically, the more of your own money that you have invested in the business, the more comfortable a lender may be that you're committed to its success. This is why you don't want to deplete your savings for every large purchase. So if you have cash set aside, and you were to take all that cash and you were to make the large purchase that your businesses need, and now your cash is depleted. Then you go to the banker and say, hey, I also want some lending. I need some additional capital. And we look at that and see that you have no cash. That could definitely hurt your chances of getting what you need for your business. So again, make sure you have that cash aside and be wary about just using all your cash. You want to see how you can use credit, how you can use maybe a line of credit to make some of those purchases without touching the other capital that you already have for your business. Conditions, these are all internal and external factors that may affect your ability to repay the loan. So internal conditions, these are plans for your loan, other resources for carrying out those plans, your experience and qualifications that could help you succeed in business. That ties back to the importance of having a business plan and really being focused on what does my business need to do to be successful? What is my experience? What do I bring to this business? And making sure your banker knows that. It is very important that we understand the plan for your business and what is your experience and qualifications in this as well. The external conditions, that includes everything that's beyond your control. We've seen quite a bit of that in the last couple of years, as everybody knows. But this also includes any industry or economic trends, what's going on in the industry that you're working on. What are some trends with your customers? We're looking at that as we go more to a digital standpoint, right? Maybe customers aren't coming into the business as much. So what are trends in that? What are you doing to manage some of the traffic that you're seeing? What's the competition doing? And then is there any regulations that we need to know about around your business that could impact your ability to do business? And then your last of the 5 C's is capacity. That's your ability to repay the loan. So lenders will want to see that your business will generate enough cash to repay the loan. And profitability and cash flow determine capacity. So again, as we talked about, consolidating your accounts, making sure it's through a business account, and we can really easily see that cash flow. That's going to help us as we talk capital with your business. All right, so let's look at what potential lenders may look for. So if you show a potential lender that your company has a steady cash flow and an effective business plan, you may be more likely to obtain credit. So when you approach your banker seeking credit for your business, be prepared to discuss these 4 key topics. So first one is credit purpose. Explain exactly how you're going to use the money and why the amount you're asking for is realistic. If you own just a small little side business and you're asking for $100,000, does that make sense? I mean, sure, everybody would want the giant amount, but does it make sense for what you're wanting to do? So if the purpose is maybe for a large piece of equipment, what is the standard cost of that? What are you going to be using it for? Or maybe you got a potential contract coming up and you're wanting to grow the business. You need access to at least $100,000 because we know standard contract could cost you 50 to 75. So making sure that we understand what's the purpose, how is it going to help you, how are you going to use it? Be transparent about this. It is important. And as we uncover more throughout the application process, it could tie things up, it could extend the process and keep you from getting what you're needing as well. The second one, credit history. Make sure there's no surprises. And again, that goes back to that relationship with your banker. Be upfront. Let them know if there is something in your credit past. Most of us have that. Just tell us upfront if there's maybe a collection in the past. If you've had recent bankruptcy, it's important for us to know because there is other avenues that we could get you with too. It's not only just the bank and what we can do. We also work with CDFIs. We have plenty of other resources that we can help you get the capital that you need. But it's going to delay the process for everybody if we don't know that up front too. The next one, company finances. So demonstrating your ability to repay the loan on time is pretty critical for any of the larger unsecured loans. We are going to ask for cash flow projections for at least 12 months. So that is helpful if you keep up with your finances and your cash flow projections. So you can get that readily to us. We want to see that you're on top of your finances, and we want to account for any potential seasonal variations. Maybe there's a dip for a couple months. We need to be able to see that. Last one, application details. Don't underestimate the importance of a complete and correct application. I shared that earlier. We do see often that there is incomplete information. We might give you a form to fill out. It comes back incomplete as well. So complete, accurate application. Make sure your dates are right, details are right. Ensure your sales and income numbers match what's on your tax return. I couldn't tell you how many times we have companies say, oh, I make $1 million annually. And then we look at tax returns and it's less than half of that too. So again, we can look at that. We understand how tax returns work. We understand how cash flow is too. But the more we know up front, as accurate as possible, will really help us again as we get you to the right place and get you the right financing. So because cash flow will be critical for financing, here's a few tips on how to help improve it. So accelerate your inflows, send invoices immediately, follow up quickly, offer multiple payment options to bring in the revenue. The quicker you get money coming in, the better for you when it comes to cash flow. Monitor your costs. So track regular bills, due dates, understand how often your inventory turns. Know what is your holding period, what's your collection period. No payroll obligations. The more you know around cash flow, the better. Watch your outflows. Use business cards, reward programs, volume discounts, trade discounts, barter arrangements. There's a lot that can go into your outflows that can help you. I personally know several small business owners that pay everything on credit. They can take advantage of trade discounts by paying early, getting a discount there. Then on top of that, they're getting rewards because they used credit, then they pay it off right away. So on top of the discount, you manage rewards. We have business owners that are getting, just thousands of dollars additional cash coming in because they're taking advantage of reward programs. So keep that in mind as well. Cover your taxes. Set aside appropriate percentage of money each month. You want to avoid penalties. You want to be able to pay taxes on time. And then lastly, challenge everything. Are you getting the maximum value for every relationship? Is there somewhere else that you could look for a vendor? Could you save money? Could you save time? Any expenses that you can cut without affecting profitability? All right, so we're briefly going to go through the business credit life cycle, and depending on where you're at in this, could determine the type of capital that you're needing and how we go about it from a bank standpoint too. So I'm going to load up this slide so you can see the different stages. There's seed, startup, growth, maturity, expansion, and transition. So we're going to load our last poll. And I'm just curious where you feel your stage is, where you feel your business is in the life cycle stages. So are you in startup phase? You're kind of just getting the idea going. You're maybe putting some money into it, getting the idea going. You're growing potentially. Do you feel like your business has matured, or are you in expansion? And I didn't put transition on there, but I would assume most of you are not at the point of transitioning your business away, but apologize if you are. So give it a second as we load up those results. All right. And yeah, as I kind of expected, the majority in startup, which is super exciting phase. In growth phase too, that I figured that would be a lot of you all today. And awesome to see that there's some in maturity and expansion too. Very exciting parts of the life cycle too. So we're going to talk through all of those today briefly, just to see what should you be doing around those stages. So the seed stage is the earliest stage of the business life cycle. Typically, you're focused on planning. You may not have started looking at financing yet, but this is a very critical time to start planning credit for your business. This is also where you really want to have a business plan built out and develop your funding strategy. When do you need capital? If you're looking at, the next year, the next 5 years, as you go through the growth, maturity, expansion phase, what kind of money are you going to need, and how can you start planning that now? So like I mentioned at the beginning of my presentation too, is when you meet with your banker, keep that in mind from your business plan. Is it okay to go ahead and maybe get $5,000 in credit, or even get a business credit card started now, so that in your future, when you're looking at growth, maturity, and expansion, your business has a credit history built up. You have that relationship with the bank, and you can get the access to capital that you need. So during the startup phase, as your venture gets off the ground, like I said, obtaining funding is critical. You do want to show that you have some skin in the game too. So a lot of times you're going to see that personal family assets are used to start business. I already mentioned business credit cards, line of credit. There's options for healthcare financing. So if any of you are in the healthcare field, I know Wells Fargo, we offer healthcare financing for startups as well. There's also micro lenders. So a couple of your resources when you're looking for this phase. All right, for the growth phase, your financing needs are going to change. You're going to be able to take advantage of, or you want to take advantage of opportunities when they come up. You might see greater access to capital during this time as you're showing growth and your business is maybe getting into the 2 to 3 years. You'll have a lot more opportunities to get credit at this time. So you want to make sure that you have capital available and funding to keep up with your growth. So it's kind of a tricky balance during this time. So some of the ways you can do this is through a line of credit. It's an awesome way to have capital available to you. There's also SBA loans, 7A, 504 are a good way to go for these. Refinance purchase loans secured by commercial real estate equity loans. So if you have a building and maybe you paid down, you've built up some equity, that's a good time to start looking. And again, we have plenty of healthcare financing options out there as well. As we get into the maturity phase, your business is never standing still. You always want to stay focused at this stage, making sure that you're staying ahead of competition, improve efficiency, and give some thought into your financing during this time as well. So some of the strategic funding decisions might be paying down debt, starting to get ahead there, refinancing any commercial real estate that you have, save some money on those, the interest that you've got. And then even looking at opening a commercial equity line of credit. So getting access to even a larger amount. And we'll see how that can help you as you go into the expansion phase, where a lot of businesses are ready to expand. They want to take their business to new places, but they don't have the capital to do it. So if you did, even from the seed phase, really start planning ahead, looking at capital, looking how you can get financing, this should be an area where you feel prepared if you've done it early on. And if not, that's okay. Talk to your banker and we'll start talking through some opportunities to get you there as well. So some of the things to consider at this time might be additional commercial real estate financing. You might, again, want to look at those SBA loans, 7A, 504 loans, and any healthcare financing that could be available during that time. There's also line of credits as well during that as well. And then transition, we all want to get to that point where we can retire. Maybe you want to sell the business. Maybe you're transitioning it to family or a key employee, whatever it is. This is the time where you want to enhance the business's value. You want to make sure that the business is stable. So if there's any significant debt, you want to look at how do I start paying that down? How could I refinance? How can I get my business just in a good area there? So I'll go real quick. I know I'm just about out of time through making sense of financing options. A lot of us understand secured versus unsecured. So be thinking through that as you're talking with your banker. Looking at financing that's right for you. Each type of financing is different. So credit cards are for those everyday purchases, maybe small things, office supplies, etc. Lines of credit, that's a revolving source of funds. And again, you may start small. You might get just $5,000, $10,000 with your bank, but over time, you can look at increasing that up to maybe it's 100,000 or more. But it does start small a lot of times. Commercial real estate financing, if you're purchasing a building, make sure that you're looking at that. There's SBA loans available, and as I shared already, healthcare financing. And then think creatively around funding. There's plenty of other ways you could go. Seller financing, factoring, or it's also called accounts receivable financing. That's a quick way to get immediate access to cash flow based on your accounts receivable and selling invoices to a finance company. Peer-to-peer lending, there's mission-based lenders, community development grants, CDFIs, MDIs. So a lot of different groups out there that are willing to provide you with access to capital as well. So wrapping up, just some free resources for you all. If you go to the Small Business Resource Center at wellsfargo.com on our small business website, you're going to see free financial education resources designed to help you improve and grow your business. There's all kinds of videos, articles, resources on credit. A lot of the information I shared today, you can get directly on there too. Also, excuse me, also feel free to reach out to me as well. I'd be happy to connect you with a banker, with a resource, wherever you might be and might specialize in your business too. So if you want to reach out, I'm on LinkedIn. You can just look at Tim Maxey on LinkedIn or email me. My email, it's tim.maxey@wellsfargo.com. So tim.maxey@wellsfargo.com. And I'd be happy to connect you with some resources. So again, some information there. And I just want to say thank you again to Robert for having me today. And for all of you that are attending, I appreciate that. All right.
Excellent. Thank you, Tim. Great presentation, great part. There's a number of questions in the Q&A. You might be able to answer some of those during Steve's presentation, or we can get to them towards the end of the wrap up. But there are some very good questions about banking in the Q&A that you may want to address as a whole group again at the Q&A section, because some of these other presentations may also help answer some of that. But with that, we'll go ahead and turn the time over to Steve.
Thank you. My background is I wasn't sure whether I wanted to be an attorney or in business, and so I got an MBA and a law degree at the same time. And in my education, getting my MBA, we one of the classes we had was financing a small business, and all the case studies we went through and figured out different analysis of all these different types of businesses, we studied in depth and detail. And so I decided, when I did decide to go into law, to focus on the financing side of law, and that type of law is called securities law. And that branched out into taking companies public. So my background, I've taken well over 20 companies public. I do merger and acquisition work. Closed a deal this past year. The business was $1 billion in revenue, and it was sold to a public company. But my first love has always been startups and small business. And a lot of us professionals, small business prediction in terms of financing is kind of like the weather. I just saw an article in the Wall Street Journal that no matter how many algorithms they have and how much software they use, they can't predict the weather. And small business is so unpredictable in terms of financing and legal issues. A lot of professionals are happy to move on and just focus on bigger, more established corporations, but I don't find that near as exciting. So I've done this for 30 plus years, and I'm quite familiar with all different types of businesses. So unlike the previous presentation, focused on credit, I'll be focused on equity, and you need both. And very often, my clients never have a chance to get debt until it's often too late to even have it make sense. So I live in a very different world than traditional commercial banker. My world is a world in which people are often writing checks, and there's not security for their return, and the checks they write could end up in being zeros versus losing some money. So it's high risk, and it involves companies where there's not security that they can give. And I think it's important to focus on the different players in the field and what we mean by the players we talk about, and also what people are looking for that are the check writers. So unlike the banking world and the real estate world, where you focus on location, do they have assets? Do they have assets to back personal guarantees? My client's story is management, and probably more importantly, the story itself, because the person writing a check is not, in this space, is not interested so much in the assets, because there's not need to secure, and they're interested in, can I get 100 times of my money? Can I get a very big return? And in a sense, go to Vegas, but go to Vegas with a team that I want to partner with and I believe in. So knowing that, it's so critical that the client I represent is able to tell their story, because the better you tell your story, the more likely you are to raise capital. So in the traditional Wall Street investment banker model, the model that I learned in business school, you have multiples of EBITDA, you have multiples of revenue, you have all of those valuations, and those come in to stark conflict with the valuation model that we have in the small business startup space, because there's no revenue, there's no EBITDA. And so the party that is raising capital is, again, it comes back to over and over, how is the story being told, and how credible is the story? Because people that are funding a small business are really funding a management team, a group that they like, that they want to see succeed. And I often tell people it's no different than funding a charity. It's a belief in a group of people that the investor really likes and wants to succeed, in the same way as if they put a donation in the offering plate, or donated to their kid's school, it's very much more similar to a donation than it is a true valuation with mechanical numbers involved and EBITDA multiples or revenue multiples. So keeping that in mind is critical, because I have so many clients and they want to spend great detail on why they're better, why their company's better, why all of the analysis as to why this particular idea is going to have traction, and why you have to have that, and that's important. Ideas don't get financed by people when they write checks. It's belief in the people that get financed by people. And what I've learned over the years, and sometimes the hard way, is this is true of people writing checks that are hundreds of millions of dollars and people writing checks that are thousands of dollars. It's a very much of an emotional decision and much less of a rational decision. And the emotions play quite a major role in the process. And that's why it's like I said to start, it's like the weather. It's very difficult to figure out who's going to be your benefactor, who's going to take an interest in your story, because we tell stories all the time and some people don't want to listen. Other people get very excited. So that's kind of the proposition I think you have to start with. And the question I get probably more often than anything is, when you have your story ready to go and you're raising capital, how do you do the valuation, which I touched on earlier? You don't have a metric of revenue, you don't have a metric of earnings. So how do you determine your valuation? And that's an extremely difficult, probably the most difficult question of all, because charismatic people that tell their story very well usually get a higher valuation than people who don't tell their story well. So it goes back again to how believable, how credible, and how the connection you have with the group that is going to write a check. Now, that said, the check writers out there have to have an interest in your industry and your proposition. So there needs to be some connection to the idea you have that they relate to. Some people want to invest in ideas that save the world, green technologies. They have other motives for investing other than just simply making money. And other people have made money in a similar industry before. They understand the proposition and they, relish writing a check. So the valuation question is often answered by looking at peer groups, seeing what those valuations are for much more established companies, and then using that as a starting place to see what sort of ballpark you can get to. But it is very difficult, I think, to quantify in any sort of regimented way, objective way, your valuation, because I've seen that all over the map in terms of valuations I thought were too high that raised money, and valuations that were too low that I thought too low and didn't raise money. So now you have kind of the fundamental story put together. You focused on your valuation. What is the market? What does the market look like in the capital raise world? And I think for the small business, it's important to focus on the fact that your initial capital is almost always going to be from what we call dumb money. And we use the term dumb money not because they're intellectually stupid, not because they they missed something when they wrote a check to you. So it's not a term that is pejorative in any way. It is a term where what we mean is the check writers aren't really focused on objective criteria and valuation criteria that the Harvard Business School party focuses on, as we talked about. There's all sorts of reasons people write checks, and dumb money writes checks, as I mentioned, out of an emotional connection or other desires that they have to be involved. Phoenix is one of the capitals in the country for dumb money check writing. And the reason I say that is we have many people that want to have lifestyle businesses. Say they sold a car dealership in Detroit, they're getting out of the snow, they're getting out of the bad weather. They come here, they're in their 50s, they are enjoying playing golf, and their wife says, honey, I'm so tired of having you around. It's just difficult. You're micromanaging my cooking, and golf isn't satisfying. Can you go find a job? And they get a knock on the door, and there's some startup, and the startup is, solar powered electric vehicle startup. And they have a new way to, do the car industry, and the car dealer understands enough about cars to get excited about the new way to make the car. And he needs a job, he needs some focus, he needs to reinvigorate a career that was over. And so while his peer group may say, your $10 million valuation's too high, I'm not going to write a check, he doesn't really care as much about the valuation. Excuse me. He cares about the involvement in the business. So he's going to write a check just to get the job, just to be in the mix of providing advice and being involved in a way that's more than just a typical check writer. Excuse me. So you can use many examples of dumb money, but I often tell my clients that almost all my successful companies, and I've had companies represented that started with $10,000 that sold in the public markets for billions of dollars. So I've seen the whole life cycle of the company from start to finish, and they almost always start with dumb money because there has to be this connection with some group of people willing to take a risk that the professional investment community is not willing to take. And so finding that group, whether it's family, friends, or people connected to family and friends, is absolutely critical and important. So if you guys are familiar with crowdfunding, the crowdfunding rules that came into being, 2013 or so, where you can, raise $1,000 from several thousand people to fund your business, is often the opposite of what you need to do, because if that's all you need and that's all the capital you need, let's say it's $1 million, and that's all you're going to be in the salad dressing business, and you're making salad dressing in a new way out of your house, and that's your passion and your hobby, and you don't plan on ever having stores and large sales, because it's going to be a business you're happy with just making it out of your house, then maybe crowdfunding works for you, because you get the capital you need to then bootstrap into operating in a way that cash flows and you don't need expansion. But if you do, then it's a very difficult jump to get that follow-on financing by starting with the crowdfunding model, because what people overlook and miss is you really want the reason that the dumb money invests with your company is they have an emotional attachment to you. And if they continue to have an emotional attachment to you, continue to trust you, and are excited about you as you progress in your business, they have friends. And usually once you establish credibility with them, they go to cocktail parties and they brag about you and they talk about you, and their friends are interested now in writing checks as well. So when you need to raise your second round of financing, then friends are available that they have, and they are fully in your camp and fully on board and more of your partner than you could ever imagine with a stepped up valuation. Because if they bought stock at $5 a share, they'd love to see their friends buy stock at $10 a share, because it makes them feel good. And it makes their bragging rights to the cocktail party even better, that they found you when you were undiscovered, and now you're being discovered, and now your valuation is double of where you started. So it's important, very important to realize for everyone in the audience that's listening today that I have so many clients and they've heard about private equity, they've heard about investment bankers, they've heard about broker dealers. They know the world of, we got to find a big slug of capital from one of these groups, one of these professional organizations. But in reality, the best money you can find often is your friends, your family, their connections, because you get better valuation, you get a lot more control. You have much less oversight than you do with these other professional financing sources. So that's important to really focus on that sector as your starting point, and not get distracted by thinking crowdfunding or institutional investor or these other areas is where I'm going to go, because I have a lot of clients that waste a lot of time, and they often, if they're successful, then the proposition of the professional is, we're going to run your business, you're going to own like 10%, we're going to have all the seats on your board, and here is all of the legal requirements that we're going to put in place for you to do anything. So in essence, they want you to, give up your idea and start and have them really, in a sense, operate from afar with all of these controls on your company. But if you're successful and you get your capital initially from your dumb money source, and maybe even you get that follow-on capital, then at some point you have to jump into the professional world of investment, and that comes in many different flavors. And one of the most common is the private equity world. And the private equity world is actually now looking at your company for the first time in an objective way. And that can be a shock for a lot of clients, because they've got their additional money from an emotional establishment and connection, and now they have to pivot to a connection that is more, that's much less emotional and more objective, where they're looking at your revenue growth, they're looking at your earnings, or looking at all the things that that you hear about, that professionals look at to figure out whether to write a check. And many times the professionals come in and they do, when they do that analysis, they realize that they need to rein in the expectations of the entrepreneur or the founder, and the valuation that they anticipated getting on the third round is really going to be far less. And that's the time which many many owners, many business people hesitate because they've had these expectations of, let's say, a $50 million valuation, and at times even the professionals come in what we call with a down round and value the company at far less than they expect. So, but that is the wake-up call, and it has to be the wake-up call for your growth, because it's impossible to raise the amount of capital you need from your dumb money investor. In my experience, most clients, in terms of just sheer numbers, cap out pretty hard at raising money from angels, family, friends at about $5 million. Some really successful can get $30 or $40 million, but that's highly unusual. It seems to me, in my experience, it's around $5 million. And then you have to go to the street, you have to go to the private equity and deal with a whole new world of objective investing. So the private equity, when we talk about equity, you want to be careful, because there's common stock and there's preferred stock. And what I advise my clients is to make sure in the dumb money stage that you're always focused on raising money through common stock, because what happens, and it's just human nature, if you raise money with common stock and then you give other people preferred stock, you often develop class warfare between the two forms of stock. And I've had clients that they started with, Series A preferred round, and at the end of the day, they had Series A, B, C, D, E, and all the way up to F in different classes of stock. And each time that they offered the equity, they had to give additional rights to the new people coming in. So we didn't have two different classes fighting, we had all classes fighting. And fighting classes doesn't help you at all when you go to the professional world in terms of that follow-on capital. And I'll step back a minute here. The other thing I didn't mention is your cap, what we call your cap table, your capitalization, who has invested, who has written a check. If you have two founders that started a company and the two founders aren't getting along and you're out raising money, that's the fastest thing that the check writers, the investors, will find out is okay, the two founders aren't really in a line with each other, so we're going to run, because two founders fighting is the worst possible company to invest in. So in terms of your attorney, in my involvement, I often, even before the process start, have to sort out who is in a line with the vision and the purpose and moving forward, and who's not. And that comes often in apparent when you have the meetings and you see founders that aren't getting along with each other. And I encourage all of my clients to sort out the founders' differences up front, because the more money you have, the more money you raise, the nastier it gets, and the more money people are likely to lose if you do get your financing. So just a side note on sorting out founder differences, but that also can happen in the capital raise process, where you have follow-on financing and the various classes of preferred stock aren't getting along, and you have to sort that out as well before you get the professional involved. So I think just to make things more in alignment and more easily financed, it's better, if you can, to always raise common stock. And there's a lot of people in this in this community that hear about preferred stock, and they hear okay, this startup in Palo Alto did preferred, so they come to me and they're all excited because they've issued preferred because that's what they've heard about. And in my personal point of view, that's not a really good idea. If you have an investor group that doesn't want to be in common with everybody else, then the convertible note is probably a better way to go. And what the convertible note structure gives the investor group is an opportunity to convert into common later at a specified price, usually at the next capital raise price at a discount, but it gives them some feeling of higher security than the common holder, but not an eternal right to have a preferred stock that exists in perpetuity over the common holder. There's an end in place at some point, and the end is usually managed in a way that they're on the same playing field at some point in the future with the common shareholder. So you've gone to private equity. Now you're past your initial capital raise stage, and private equity tells you, no, we want all this on the list of things for you to do, and we want 2 board seats, and we want 3 times our money before any commons paid out, and all the things where they get a higher return, because the goal of private equity is to get out their initial investment and more and have a little bit ride for the exit, but they're not on the same page ever with your initial investor of common of they're in for the full long haul. And when the exit happens, they're going to make either nothing or they're going to make a big number on their initial investment. So the private equity is realigned the risk in the company so that they are looking at some amount of payout that happens before the common stock payout. And if that's not your cup of tea and that's not what you want, then you're stuck in a world of going to the public company markets. And you saw that in spades and all the disasters that occurred with these SPACs, the special purpose companies, and Wall Street, which in the Arizona market would have been shell companies, and that gives the entrepreneur and the founding team, way more latitude and leeway to run their company, but also is much higher risk on your exit and your ability to raise the capital, because you have to move into these vehicles before you're certain that the capital you need can be raised. And so that's kind of your choice. You either, in this world of capital raise, take on the lower risk option of capitals for sure, but there's a lot more control over the capital of private equity, or you go to the public markets, you have a lot more control, but much less certainty of raising the money. So I have a minute left, and just to summarize, because there's a lot I covered here, for those people in the startup world, focus on your story, focus on how you tell your story, your management team, whether you're getting along with your founder, how you resolve the differences if you need to, what type of capital you're raising, the expectations of your valuation in raising the capital, how you're going to jump into the objective private equity, objective market of valuation, and have a smooth transition into that world of finance.
Excellent. Thank you, Steve. I'm going to ask you a quick question that we have in the Q&A box real quick, because I think it'll apply to a lot of people at this moment. And it says, how does one determine the valuation for a new concept in an established industry? So it's a new startup business.
There are, in the public markets, there's what we call SIC codes. And if you go to sec.gov, sec.gov is the holding, it's where all of the companies that trade in the market are listed. And if you do your research and find out what SIC code applies to your company, what's tricky is if you have a better mousetrap for an existing industry, you would start with the code for that industry, and then you would try to find a alternative code that's outside the industry. Let's say it's software, and you probably would have a hybrid of the two. And then you would go to back to your own company and say, okay, the industry I'm in is an EBITDA multiplier of 5, and then the software that I'm seeing in this other industry is 10, and somewhere between 5 and 10 is probably where you would land, with some discount for your fact that you're a startup. So that's about as objective an answer as I can give.
So one way I think to help with, that question in terms of the valuation too, would be work with your accountant, who we're going to jump to next with Chris. So Chris, we'll turn the time over to you to talk about accounting and how we can help out businesses looking for capital and growth.
Thank you. Thanks so much for hosting me, and I'm happy to be here. What great advice we've already got this morning, and I'm looking forward to adding to it now. My name is Chris Henderson. I'm a principal here at REDW. We're a CPA and business advisory firm in the Southwest. And a lot of what you're doing is what organizations need in order to prepare for their capital raises. So I'm excited for all of you to be here today. One of the things you just heard Robert say, and Steve and Tim, is you need to engage the right professionals and have the right information so you can share that story with your potential sources of capital. I'm happy to contribute to that today as well. Our firm does do tax and audit compliance through consulting, human resource consulting, wealth management, software. My specialty is capital advisement, client advisory and accounting services. And I'm excited to share with you today. Accessing capital is one of the most exciting things you can do when you're running a business. It's also the exciting part for us as business advisors. We have guided clients through lots of different types of transactions other than going public. For us, that includes private equity transactions, private investors, banks, and other non-traditional lenders too. Today, I'm going to be presenting to you a CPA's perspective on accessing capital for small business growth. And I'm going to focus on 5 items in particular. And these are forming relationships with your sources of capital, having a clear, detailed financial plan, staying current on your industry trends, maintaining accurate, timely financial statements, and building an advisory board for your business. Let's get started with relationships. I was actually really excited when during Tim's presentation, he said, cultivate your relationship, visit your banker regularly. And we're both sending you that same message because of how important it is. And there's nothing like knowing in advance who you're going to call when the need arises, rather than waiting until the need arises and not knowing what to do. Whether you're looking for debt or equity capital or another source, the first piece of advice I have is pick up the phone and reach out. To focus on debt sources of capital first, those would be your loans, your lines of credits, and similar things. Banks are eager to form relationships, and they really are looking for relationships. They're not looking to throw a wall between themselves and you. They're also eager to lend. That's how they make money, under the right circumstances, of course. Banks can help you know what will be necessary in order to get capital once the time arises. That's both in the form of knowing what the application would look like, what type of metrics you would need to hit in order to be qualified. Tim called himself a coach earlier. That's exactly what I'm referring to here. Banks are willing to do this, and they want to do it together with you. And when your bank says, well, we want you to hit a times interest earned debt service ratio of, if you don't know what that means, that's where we step in as your accountants to help you make sure that you are prepared and make sure that you're hitting the right ratios you need in order to access the capital you need for your business. Many banks are different. And so one of the things you'll want to know in reaching out to several different banks is what can and can't they use as collateral, whether they underwrite nationally or locally, whether they support certain industries or stay away from certain industries. It's important for you to know these things in advance, again, through forming that relationship so that when you're ready, you know you have one or more banks or other lenders to deal with who are ready to work with a business like yours. Don't forget there are other sources of debt financing than just banks. There are, for instance, debt funds that are similar to private equities, but these focus on the use of debt or convertible debt rather than an equity investment in some cases. The other thing that you should know too is debt does have some tax advantages potentially for your business because you can deduct very likely some or all of the interest expense you pay as part of your monthly payment on the debt. However, speaking of monthly payments, don't forget that debt comes with that obligation to turn around and repay. Typically, of course, those are scheduled, so it's easy to predict, and you may be able to work with lenders to, for instance, defer the 6 months of payments or things of that nature, or have a period where it's interest only. That, of course, relies on your relationship with your source of capital, but those payments will impact your cash flow. And therefore, debt investment tends to be somewhat less flexible in general, but also, to speak shortly about equity investment, debt investment doesn't typically involve giving away any control of your business, which Steve mentioned previously in his presentation too. So let's talk a little bit about equity. So debt and equity investments are frequently looked at as the two maybe primary sources or general sources of investors. Equity investors would also love to form relationships with you. They also want to invest. It is also how they make money, just like banks and your debt investors. So just like banks, though, each equity investor is different. So look at your investors as a partner, not just a source of money. What will be the best kind of partner for you? Do they have history in your industry? Have they had successes or failures that you're aware of already? And then what do you need from your partner besides just their money? Do you want their expertise? Do you want guidance? Do you want advisement? Do you want consulting? Here, I'm using the term partner loosely, not referring to any legal entity of a partnership. Note that some investors, as Steve mentioned, will look for you to have tapped out friends and family capital first. It may also be important to these investors that you've looked for other things such as state credits or incentives or grants. These may be available to you through state governments or local governments or other agencies or organizations who are looking to spur commercial activity in their communities. Look for those sources of investment too, although they tend to be a little bit smaller.
Hey, Chris, real quick, did you want to start your slide deck?
Oh, I'm so sorry. Thank you. Perfect. All right. I appreciate that. I am keeping my slides a little simple, and that's on purpose because I want to focus on the conversation that we're having today. It's also important to note for equity investors, they are going to look for not only the rate of return, but also how long their money is going to be at risk. Steve pointed out, for instance, that some investors are going to look for a return on their funds rather immediately. It's important to know that, again, by forming relationships up front. One other thing for tax purposes, you may not be able to deduct any of the cash that you return to your investors against your taxable income. However, your cash flow outflow to your investors may be much more flexible than, for instance, a scheduled repayment on a loan where you're required to make those payments. Your equity investors may be able to flex or set terms such as a minimum level of cash flow or other ratios that allow you to make your cash payments back to investors more easily. So again, the number one takeaway here is give yourself the advantage of time by forming your relationships with your investors early. The second item here is, and this is a challenge, build a detailed business plan and add to detail, add to detail, add to detail as you go. Steve said earlier, the better you can tell your story, the more likely you are to raise your capital. I couldn't agree more. You need to be able to tell your investors how much you need, when. Do you need it all at one time or over time? Why can't you self-financing, or why are you choosing not to pursue self-financing? And how will you ensure their return on investment? The more you can tell that story, the more likely they are to invest and potentially even invest more. When you're putting together your plan, detail is key. I often encourage clients, start with napkin math, write it down on the back of the napkin, large round numbers. But then you need to ask yourself, yeah, but how do I know? And that answer to that question becomes the next level of detail in your model. And then you ask yourself again, yeah, but how do I know? And the answer to that question becomes the next and the next and the next level of detail. The more detailed you can be in building your model, the more successful you'll be able to be in working with that model with investors and discussing that model with them, showing them the range of potential inputs and outputs in that model, and even getting their help. This again is where the relationship comes into play, even getting their help, providing constructive criticism on your model and helping you to hone it so that it's more robust and honestly believable by them. Repeat to yourself the mantra, know what's knowable. If there's a piece of data that you can access, such as the market size or the average price or some type of multiplier, go access that data. Having that data in your model will help show the investors how well prepared you are and how informed. Lacking that data will show the opposite as well. The more detailed you can be, the more you're also telling your story, just like Steve said earlier. The third item is to stay current and up to date on your industry trends. Your investors may be experts in your industry as well. In fact, your relationship with them, again, may be one of the sources of industry data that you rely upon, but it's equally important that you show them you know your industry just as well. Reality is, in most businesses, industry trends are inescapable, and it's going to be rare for you to either be immune to industry trends or to create those trends yourself. Show your investors that you're aware of the trends, aware of changes, aware of risks and opportunities in your industry, and that you already have contingency plans in place. So you proactively set your plans so that in response to certain industry stimuli, you know how you will react. Again, the better you know your industry news, trends, and more, this is where you'll be able to tell a better story for your business and show how ready you are for their investment as well. The fourth item, and this is the most exciting part, I know, is to maintain accurate, timely, and financial statements. And yes, financial statements. Now, I know that you're as excited about your financial statements as I am. I would just ask you to hold your applause for a moment and let's talk about this for a second. As a CPA, I am basically required to make a shameless plug for accurate and timely financial statements, but I can't really understate how critical they are to your business. A basic balance sheet and income statement show your investors what you have achieved year to date, life to date, or period to date for your businesses, and where you stand today. That helps them and you assess the financial health of your business and what is the starting point for any projections or budgeting or forecasting that you're doing. You'll want to be able to convey profitability. I believe that Tim discussed that as well. This is the ability, it's very simple, the ability for your business to generate profits, revenue exceeding expense, simple enough. You'll also want to be able to convey liquidity. This is the ease of access of converting your assets to cash, collecting your receivables, selling inventory and collecting the cash on those sales, and other similar conversions of assets to cash. Solvency is the ratio or amount of assets, hopefully in excess of your liabilities, typically looking at things that you could convert to cash in the next 90 days and obligations you may have to pay in the next 90 days. Sometimes you look at as far as 180 days. But profitability, liquidity, and solvency are among the top three that you'll want to look at for your organization and be able to show on your financial statements. Now, I know this seminar is about obtaining capital from investors. And so why are investors looking for you to already have some capital on your balance sheet? Well, the answer is they want to see that the organization they're investing in is healthy already, not at the bottom of the barrel and barely scraping by. And so you want to be able to convey that in your application, in your presentation, in your models. Organizations are going to hesitate to invest when they see that the potential investment target has failed to either generate capital through its sales or retain the capital that it has generated. One thing you'll see in the news is organizations like Amazon or Netflix going years before making a profit, but still getting lots of investment. Well, sure, that can happen. But more likely for us at this level, we're looking to show some health in our organizations before we're able to attract some capital. Now, there are countless other financial ratios, probably thousands, other than just profitability, liquidity, and solvency. And it can be hard to choose from among all those metrics and ratios, and then to actually plot them and track them, know what they mean, know what to do in a response to a change in one of those ratios. I would encourage you reach out to your friendly neighborhood CPA, but also reach out to those relationships. Again, your potential sources of capital, your industry guides and industry news that you're following and staying up to date on. Those can be great areas to focus which key performance indicators you're looking at and tracking for your business. And it makes a great story to tell to your investment class if you can show these are our metrics relevant to our industry, and by the way, benchmarked to some of our industry peers. That shows a lot of forethought, a lot of planning, and a lot of use of your financial statements as a tool by management. That's you. Your investors, debt, equity, and otherwise, they're mostly getting a financial return on their investment. Some of them get a nice feel-good return, and that's great, but a lot of them are looking for a financial return as well, or primarily. What that means is that their interests are going to be largely financial. If you can demonstrate to them through use of your financial statements that your interests are aligned with theirs, also financial, not only financial, but also financial, you'll show that you're aligned with their interests as well, which goes a long way towards forming that relationship and maintaining it. I do want to take a moment to slow down here. After all, I'm an accountant. This is my profession. Clean, timely financial statements really excite me. But for some people, it's a challenge. You may not be an accountant. Some of you on the call today might be starting your own accounting firms, and congratulations. I'd be excited to work with you in the future. But some of you have no idea about accounting and financial statements or ratios or some of the things that we've discussed today. What I would recommend is find an advisor and create a relationship. I'm saying it over and over, and I understand that, but it really is very important. Also, your time as the business owner or executive here is not well spent entering accounting transactions into an accounting information system. You should be obtaining capital, growing the business, finding new clients, working on the business model itself, working on the business itself, and expanding your business horizons, not manually entering accounts payable or checks or other things, or reconciling your own bank. However, if that's not being done somehow for your organization, you will fall behind and have an inability to provide financial statements, not only to your investors, but to yourself. The best advice I can give in that regard is to seek to automate as much of this accounting as possible and outsource the rest that you can't deal with. It really is a much better value to you to make sure that you're spending your time growing your business, finding new clients, expanding your horizons, than working on mundane details. However, you'll find if you don't have your financials, again, they're not really that mundane. It's important to you as an organization to also stay lean. Your investors are not going to want to see that you're making huge investments that aren't growing the business necessarily. So focus yourself on accounting informations that can be rented online for low monthly fees. There are a lot available. QuickBooks is one. You've all heard of it. It works very well. Sage Intact is another. BotKeeper, Bill.com, Expensify, Dext, AutoReview.io, Fathom. We're using all of these same systems that are available to you when we outsource services for our clients. You can use these systems to connect directly to your banks, to your credit cards, to your other sources of accounting information, and have them flow directly into your accounting systems for you. At the very least, that's going to give you a good idea of the completeness of your information. The beauty of these systems is they're typically available to you for no long-term contract, a small monthly fee. I can't encourage you more. Engage an accounting system right away so you can get those clean financial statements timely. One other thing too that your sources of investment are going to look at is taxes and compliance. I have seen a number of investment transactions get shut down immediately because they have found out in the due diligence process that the target is not up to date with one of its tax compliance filings.
I just want to share briefly the fifth item. I guess wrap up very quickly with the fourth. Don't forget, again, if you have not only your income taxes, but your sales taxes and your payroll taxes are two other forms of tax that can really hold you behind from investment if you don't have those up to date. For the fifth item that I want to share just briefly is to maintain, oops, I'm sorry, let me get my slides to advance one more time, is to build an advisory board for your business. They don't have to be paid, they can be unpaid, but seek industry experts, perhaps industry retirees or other people who you trust, maybe local executives who aren't in your industry, who can help be an advisory class to your business. I'm sure that Robert was sharing my contact information. It is on my final slide. I'd encourage everybody to reach out, and thank you so much.
Excellent. Thank you, Chris. With that, we'll turn the time over to Nancy Sanders. Nancy's going to touch on some things that her organization provides to help support small businesses. And as Chris was talking through those 5 pieces, and he mentioned equity, a lot of what Nancy does can help with debt and equity. So we're excited to have Nancy with. All yours, Nancy. Looks good.
Thanks, Bob. Okay, thank you very much. And good morning, everyone. I feel like this is kind of like I'm the last speaker before lunch. So, but I'm going to make this very quick. And really, this is a great opportunity for me to wrap things up, because really the America's SBDC Arizona, the statewide network, we are able to kind of pull together all of the great information that Tim and Steve and Chris shared and advise you into how to move forward. So that's my goal today. Whoopsie. Okay, there we go. So I'm actually in a relatively new position, an interim position, but my background is that I ran the Maricopa SBDC Center for a number of years, and just want to also let you know that your statewide network is supported by your tax dollars. We're funded by the SBA, but then we also receive funding from our hosts, which are community colleges around the state. And I'm very happy to say that we have a long-term relationship with the Arizona Commerce Authority and receive funding and support from them as well. So you have gotten a lot of information today, and I know I took notes, and I have questions that I want to share with some of the people I work with, some of the information that I received today. So just to kind of give you an idea where we come in, as I said, we're really in the position of guiding small business owners through one-on-one free counseling, and then additional resources and training as well. So probably no surprise that last year, on the last 2 years, our network has seen a record number of clients. And of course, a lot of that was assistance with disaster assistance, but we typically work with clients on both debt and equity investments, but primarily debt. And of course, we work a lot with lenders such as Wells Fargo. In fact, I'm going to talk a little bit about one of the programs we have that is actually brought to you in part by a statewide grant that Wells Fargo provided to Maricopa Community Colleges Foundation. So I'm going to talk to you about that a little bit later. But basically, we worked with almost 6,000 clients across the state. We do work with startups, but really our services are really more valuable to those of you who are looking to grow and expand your business, which was a lot of you in this session today. Will you go ahead and launch the poll? Just to get a little clarity about where you are in your journey. If you're just getting started, or you have just recently invested in money to grow your business, or are you ready to expand and really want to take it to the next step? Give you a couple of seconds. Okay, great. You know I speak for Tim and Chris and Steve, along with Ray and Bob, that is very exciting news, that 85% of those of you on this in this webinar would like to expand your business. You're ready to grow, whether you need to add people to your team, whether you are looking to invest in equipment, or maybe open a new location. We are seeing a lot of opportunities there. And so one of the things that is important to know is that when you work with the Small Business Development Center, we address your specific needs. So frequently clients come to us who kind of fit into the category that Steve talked about. Hey, they've got an innovative idea, or they're an established, they have an established company, and they're looking to raise funds through equity. But generally speaking, most clients say, okay, well, I need a loan to buy a piece of equipment. I want to open a new location, or I want to buy a building. And so that's really our sweet spot. And by the way, I said your tax dollars at work. We have contracted goals with the SBA, and our mission, or our primary focus, is to help small business owners like you get funding, whether that is debt or equity, but that's really our mission. And so one of the things that we launched in the last few months is a statewide, what we call a money team. Now, I know this workshop is called Capital, and that's actually the name of our goal with the SBA is Capital. And everyone on this call, or all the panelists that you see, we all know what capital is. But what we found is that a lot of small business owners don't know what capital really is, or have to really think about it. But you don't have to think about what money means. You all know what money means. And so we put together this money team with former lenders, as a matter of fact, and established business owners to really help guide our clients throughout the state. And as I said, we received a grant, or we didn't receive the grant, but Wells Fargo funded the Maricopa Foundation. And one of those programs is specifically to do outreach to businesses like yours that are looking to grow and expand. And then the other piece of that is a small business matchmaking session, or a program as well, to match small business owners that need services or have a need for talent with fledgling business owners, or perhaps students launching businesses, to provide them with services like, for example, both Chris and Tim talked about financial projections. That's a pretty intimidating thing for business, even established business owners, to do. So maybe you need some help preparing your financial projections. Tim talked about 12 months. We usually advise clients to look at 2 to 3 years out. And so, someone can help you with that. Someone can advise you in putting together a social media campaign, or how your website could be freshened up. So that's kind of this, it's called AERO, is AERO. It's Advancing Entrepreneurs Ready for Opportunities. So that and the money team are part of this new program that we have. But the ongoing assistance that we provide is just, Chris talked about a business plan, right? Tim talked about a business plan. So a lot of clients come to us when they're looking to grow or start and say, I need a business plan. What does that look like? So we have a number of resources for you, and of course, guidance to help you polish off a business plan that you have. Or maybe you have a business plan, but you're looking to expand, and so you need to update it. We also have a number of specialized experts in the area of manufacturing, international trade, technology, commercialization, sales and marketing. So if that's the area that you need assistance with, we're able to provide that that assistance, that guidance as well. And then I mentioned that we have a number of tools and resources. So one of the things that that Tim didn't go into detail about, but when you do go to Wells Fargo and you apply for a loan, then they're going to do their own analysis and their own underwriting. And so some of the tools that we have access to help tell your story. Many of the panelists talked about that. You need to be able to tell your story. So we have templates, I should say, or tools related to planning, business planning, and then also market research tools as well to help you collect that data that's really important when you're putting together your package, if you will, your loan package, or just getting ready to put together your loan package. And so I'm mentioning Wells Fargo all the time because, well, obviously Tim is part of the panel today, but we work with a number of lenders, both SBA lenders and then some of the other types of lenders that were mentioned, micro lenders, et cetera. And we, depending upon the comfort level you have, we might call up a lender and say, hey, we have a client who is an established restaurant. They're looking to add another location. Is that something that you have an appetite for? And then Tim and his team say, yes, we do, or no, that's not a good fit for us. So we help you get prepared so that you are ready, but then also that you go to the right lender for your type of situation. Because you saw that you were looking at the Q&A, some of the things, are a great fit for Wells Fargo, and some things maybe another lender has an appetite for. And so how do you get started? How can you get all these tools and free counseling? So we have a statewide website, azsbdc.net. You can go on that website and request counseling. Then you are paired up with someone who is in your geographical area, because we cover the entire state, and also someone who's a good fit for you depending upon what type of business you're in. And then you'll work with a client, you'll work with a counselor on an ongoing basis, not just to get ready for the lending piece, but also to address your goals and your objectives long-term. So that's a little bit about the Small Business Development Center. And I think I managed to keep this on time. So we're able to answer, good, because the panel, I'm sure, would love to answer more questions. And a question that I see in the Q&A was, do we work with nonprofits? So the SBDC is unable to work with nonprofits unless they are working with other small business owners. So for example, we can work with a chamber, for example, or an economic development organization. However, our sister organization, SCORE, is able to work with nonprofits.
Excellent, thank you.
Bob, any other questions? Thank you very much for including me today, and looking forward to working with all of you. Thanks.
No, we're glad to have you on. I just can't reiterate for all this, the new businesses, the true small startups, family businesses, or people looking to start that. The SBDC is a great resource, great starting place. If you're in that ideation phase or in the process of starting it up, just as Chris had mentioned, having that advisory team as part of your program, your platform, the SBDC can be part of that advisory team. It might be you and the SBDC, and maybe your spouse might be your advisory team, but it's a start. So it's a great place to go. So we have a couple questions in here about trademarks and protecting your team. So Steve, this may be more up your alley, but the first one is, how do you protect your idea when presenting it? So when you're pitching it to others for funding, how do you protect your idea? Does an NDA really work when someone can say they have already thought of the idea or sends it to a friend? Steve, you there? Or Nancy or Tim or anybody? Any ideas on that?
Well, I was just going to say, I'm going to speak for Steve now and say that investors won't sign NDAs typically. That's been our experience. I'm not saying that's 100% true, but frequently clients come to us and they say, hey, I want to, pitch my idea. I want to share some things, but this group won't sign an NDA. And so from the other side, from the counseling side, yes, you do want to collect an NDA. We have for instance, we have a confidentiality agreement that we have with our clients. So we can't talk about our specific clients to people like Tim and Chris unless our clients expressly say we can talk to those people. But yes, I think that you do want to. So there's a fine line, and maybe Steve, I see he's not muted. Maybe he's back on.
Yeah, I'm back on. That's great point. Can you hear me now?
Yes.
Yes.
The problem with NDAs as well is they're not very enforceable. So it's what the industry does. It's better than nothing, but to truly protect your idea is extremely difficult because courts aren't in the business of figuring out through injunctive relief whether an idea was stolen or not. It's just not what judges are set up to do. So it's the best we have, but it's really not frankly that effective in protecting an idea.
Excellent. And then we have another question that came out. It says, do you recommend registering your company name and logo as trademarks?
Yeah, absolutely. A lot of people overlook that early on in the process. The Chinese have taken a lot of trademarks, trade names, and use them for nefarious purposes. And so it's really, really important to not just register from a state level, because sometimes people save money or realize the state trademark's easy. Just get your federal trademark and get it as soon as possible. Trademark not just your name, but your logo.
Excellent. And then we have another question that's popped in. It says, in the technology consulting area, capital and assets are very subjective. How do you represent them properly?
Maybe Chris, I'm not sure the capital versus technology questions. I'll punt that to the accountant.
No, it is a really good question. And if I follow the question, you're probably more indicating, how do we value intellectual property of some kind, especially software, things of that nature. And there are two different types of value, don't forget. So there's your book kind of accounting value, and that's just following generally accepted accounting principles here in the United States, or another body of accounting principles. What you're probably asking about is how would the market or an investor, especially an equity investor, value the IP or the organization or both. In that case, I would have to encourage you to get connected with a valuation professional, and they will help to establish that value for you. And then there's always a difference between value and price. You may establish the value for the business, but someone may be willing to pay a higher price because they really want it. Or someone may be looking to get a great premium and want to pay a lower price, and perhaps you're willing to take it. So I know that's a kind of half a meal in terms of a response, but make sure you're connecting yourself with a good valuation professional.
Excellent, thank you. Now we have another one in here that is really kind of sums up. It's a great one after everybody's presentations. Because we're talking about gaining access, to capital to grow your business. It says, is it difficult to get funding to hire staffing that will allow for business expansion? What are some of the requirements or hurdles?
Yeah, I can share from the bank perspective on that too. Is a lot of times if we're looking at like growth phase or expansion, if you're coming into the bank and saying, hey, I need this line of credit, I'm hiring some people, or I need some money, I need capital, I'm hiring people, that could be difficult because that could take time. So I would go back to the point of get financing and have that in order early. So if you could have a line of credit set up, that's something that could definitely help you as you're looking to grow and hey, I have to hire a couple people to get this contract or to expand or to go into this market. That line of credit can help you with that ahead of time until some of the cash flow starts coming in. So again, the earlier you get some of the financing, get a line of credit, the better. It's really going to help you think ahead on that.
This may also, I'm sorry, go ahead.
I say, with that line of credit, I heard this, and you can confirm it, that when you first go into your bank to get your business bank account, to ask for that line of credit or business credit card, and then actually use it and pay it off, kind of like you mentioned in your presentation, to help establish that credit, show that lender that you do pay off your debts and so forth. You may not need to use it, but use it, pay it off, use it, pay it off, helps build that credit.
Yeah, absolutely.
I was just going to add briefly, if I could, for hiring in particular, there are a lot of state incentives and local incentives that may be available to you depending on the type of hiring and the size of your business.
Yes. We got a question. Can anyone address how to best search and access federal and state grants for a startup manufacturing plant for sustainable shipping and packaging products? I can actually jump into this, and Chris, you look like you're going to say something maybe, but
please go right ahead.
The best way to look for grants, if you think you have a technology that may have something, is grants.gov. There are not a lot of grants. There are some competitive grants that are available, and it oftentimes just takes Googling and searching for different grants, but there are not a lot of grants out there to start businesses. There are some misconceptions that there's lots of grants for startups, and there's really not. There are some competitive things though. So for our caller, Jeff, for example, it may be something that you look at the Arizona Innovation Challenge. It is a business plan competition for tech and startups. And there is some grant funding tied to that, but it is a highly competitive process. However, the winners, besides the grant funding, get to go through a world-class accelerator program as well. So that's definitely something to look at. The next AIC probably isn't until next fall, but it's a great program. And there are some other business plan competitions where some of that sustainable and tech manufacturing stuff may come into play, that you can look at those business plan competitions and potentially win some grant funding there.
Hey, I'll add too, if you go to wellsfargo.com, search grants, we also work with some local nonprofits as well that can help provide grants for your business too. So just go to wellsfargo.com, search grants, and you'll see the page come up on that.
Also look at your state Secretary of State website. There may be things like job training incentive programs or other types of incentives that you may qualify for. However, those do tend to be for slightly larger businesses.
For some of those state incentives, you want to go to azcommerce.com and then look under programs. And it will list all the state incentives that the Commerce Authority manages for those different programs. All right, and the last one I think we've got here right now is, can we use an MSA as collateral? This might be for Tim or for Chris.
Good question that I don't know the answer to. So I could find out more and get that over to you, Robert. Yeah.
Okay.
I would say that it depends on what the MSA is, because if it, if it's a, let's say it's a contract, it's a federal contract, or something along those lines, or it's, it's an established agreement that's gone on for quite some time, then lenders might look at that favorably. But it really depends on what the agreement is and what's the risk? Let's face it, what's the risk? So Tim talked about this earlier about factoring or looking at accounts receivable. That might be something that you could pursue as well.
Yeah, I was going to add that, there are forms of kind of alternative financing that would include factoring or even financing purchase orders or things of that nature, so you can help fulfill them. This would probably be akin to something like that. And it would just depend on finding the right organization to provide the capital, who would be willing to take a little bit more risk. They're basically trading entirely on your future in that case. I suppose you could probably find someone, and actually what Tim said too, don't forget the banks and the more traditional lenders have connections into those kind of non-traditional lending markets. It's a great place to start as well.
Excellent. So yeah, one last question we're going to sneak in, and I'll probably end up answering this. It says, I launched a local digital directory service and have used my own money to fund the website, marketing, and better features for my site. I'm trying to get people to sign, for free to sign up. What are your suggestions to promote? We've done a lot of marketing webinars on the boot camp. I would definitely look there for some of those webinars. We also have some upcoming ones in about a month or so on marketing and driving people to your business through marketing. But we have a lot of good recordings on a boot camp that you can go access to see in more detail some ways to help drive people to your business. And then we have another one. Nancy, any suggestions on finding a mold manufacturer? With that, the Arizona MEP, the Manufacturer Extension Partnership, can do a search for mold manufacturers to help your business. I would encourage you to get in contact with them. You can find them again at azcommerce.com. Across the top of the page under programs, you'll scroll down the programs page a little ways, and you'll see manufacturing, and you'll see Arizona MEP. And you can connect with them, and they can help you out with that question. So excellent. Well, we are right at time. Wrapped up with some good questions. We appreciate everybody participating. We appreciate all of our panelists. Nancy from the SBDC, Tim from Wells Fargo, Chris from REDW, Steve Boatwright from Gallagher Kennedy, and Ray Shea from the Phoenix Business Journal. Again, I'm Robert Theobald with the Arizona Commerce Authority. Thank you for being here. Thanks for coming back on after our slight Zoom glitch. But we appreciate everybody being here, and look forward. We're going to continue each quarter doing this workshop with taking feedback from this one, providing a little bit of new content, maybe making some adjustments as well. And so be on the lookout for that, and along with other workshops that may fit your needs as a small business in Arizona. So please keep in contact, stay with us, and we'll see you soon on the next workshop or the next webinar. So thank you very much, and everybody have a great day.
Good job, everyone.
Thank you, everyone. Take care.